Again, I'm going to take, for the McDonald's valuation, I'm going to take this very simple file that we downloaded from Bloomberg, and it's just got some of the data, not all the data. I'll make it a little bit bigger so it's easier to see. But I have 5 years of historical data. Right? I'm calling it 640. Now, I'm going to add a tab, and this is where we're going to do our valuation. Right? Now, what matters is I want to forecast the future, but I am going to use the past to help me predict the future. All right? So one of the problems in finance, and this is what we'll talk about when we get to the whole portfolio theory stuff, is people assume at the portfolio level that the past repeats itself. And in the reality, the real world, that doesn't always come to fruition, but the past informs the future, is the only way that we can act. So we do historical analysis so that we can make assumptions about what the future is going to be. So what I'm going to do is I'm going to use, and again, I'm sure you guys are familiar with Excel. You've used Excel somewhat in your MBA programs? Okay. So relative references are helpful, so that way it's easy to reuse the data and update it if the years change. So what I'm going to do is I'm going to say equals, because it's going to come in the exact same format. I'm just going to take these years, and I'm going to take the historical years through 2014, which is reported here. Okay, so copy and paste that forward. Then I want to just take some of the key metrics, and the metrics that I'm going to want is I'm going to want growth, and then I'm going to want EBITDA margin. I'm going to want DA, basically depreciation as a percentage of sales, right? Depreciation, amortization, so that I can get my EBIT or operating income as a percentage of sales, right? And then basically I'll need a tax rate, which will then get me my NOPAT. Okay. Now, very simplistically, what is my formula for growth? Growth is equals current year minus previous year divided by previous year. That's the formula for percentage change in growth. Right? Why did I only do it in 2011, not 2010? Because I don't have a 2009. So I can only do 4 years worth of growth. And I'll do it to 1 decimal place just so we can see a little bit more granularly. But these have been McDonald's historical growth rates, plummeting from 12% to 2% to negative 2.4%. If you wonder why the CEO got fired, there you go. Like, that's just been a very bad track record in an improving economy, right? But the next is, what's the EBITDA margin? And that is, for 2010, EBITDA divided by revenue. So again, as a percentage. Depreciation, I'll just do all the percentages at once. Depreciation as a percentage of revenue. Spent about 5% on depreciation. EBIT, I can do it 2 ways, but I'll just use the actual EBIT divided by revenue. Right? Tax rate is the effective tax rate. Now, I want this to be a percentage, so what I'm going to do is I'm going to divide that by 100 to turn it into a percent, because it comes out as like 29 something. I don't know what is a percent. And then my NOPAT as a percentage equals my EBIT times 1 minus that tax rate. So that is my net operating profit after tax as a percentage. Yes? So the NOPAT is this EBIT times 1 minus the tax rate. Okay? And then I'm just going to take these formulas and copy and paste that over. So that's McDonald's historical ratios. Everybody with me so far? Questions about what we just did? Sorry, my watch is ringing. No? So what I did for NOPAT is I just took cell B5 and I multiplied it by 1 minus B6. Okay? So it's the EBIT after tax. The tax rate is 29.3, which means it's the same thing as multiplying by 60.7. Okay? 1 minus the 29.3. Questions? Other questions? Yes?
Sorry, I just
I just took the EBITDA that the company reported and I divided it by the revenue. This was from the financial statement analysis video. This is also the accounting stuff that hopefully you get done. But these are the financial metrics for McDonald's. The reason I'm doing this is I'm going to give you a best practice in equity valuation. You don't forecast revenue. You don't forecast cost of goods sold. That's the worst valuations you can do. What people do is they forecast the ratios. And then the ratios create the numbers. So if you actually look at the process, I'm doing subtly, there's actually a method to this. And what you do is you take the historical data, income statement, balance sheet data, and you turn it into ratios. And then you forecast ratios, and then you create the statements from the ratios. So that's why I'm doing what I'm doing here. So the first step was get the data. Second step, create the ratios. Now we're going to look at forecasting some ratios for McDonald's. But this is what I mean by historical analysis. I can kind of see what's been happening to McDonald's. So what trends do I start to notice for McDonald's? And they're all bad. Sales are declining. 1, 2. It's actually declining. So getting less sales, shrinking, less margin, more in taxes, and less NOPAT, right? Less profit after tax. So I'm just saying, we're making less, we're selling less. It hasn't been a good run for McDonald's the last few years. And what you'll see when you get the data is same-store sales have been declining. They're not having success with new sales because people, particularly in the U.S. and now in Europe, are looking at them and saying, Big Macs have all these processed foods. I don't like processed foods anymore. And people are going to fresh food, or they're going to organic food, or they're going to like non-antibiotic chicken. And as a matter of fact, there's a shortage right now that Chipotle is having because there's just not enough of this stuff to go around. And they've been gobbling it up. And McDonald's, even as they want to go fresh, there's not enough fresh stuff to go around. There's supply chain problems. But more importantly, they're having a perception problem because people don't believe that they've got healthy food no matter what they say. So that's their big problem. And it's affecting their valuation. But again, you can start to see the trends in the past. Yes?
So the tax rate percent going up, is it simply because actual changes in regulations?
Short answers could be for a lot of reasons. For tonight, I don't really know what it is. We'd have to probably go look.
You also mentioned like restructuring capital.
Could be a lot of different reasons. Could be more debt or less debt in that case. Could be more sales in the U.S. versus international, so they're paying more higher tax rates. Could be that they're having to pay deferred taxes after a couple of years of not being able to grow, so therefore they have to pay the deferrals. They're not producing new tax credits by getting new CapEx. As I said, I don't really know, and for purposes of tonight, I'm going to try and keep it simple. But his question is a really good one because we would want to do this professionally, dig behind these numbers, and we want to find out why these things are changing. All right? But on a very simplified level, we're just going to assume they're changing. And we're going to make some assumptions about the future. Everybody with me so far? So let's talk about the future. So here's what I'm going to do. I need to forecast the future. So I'm just going to call this 2015. Now, ideally, I'd want to do previous year plus 1. But the problem is if I do that in Bloomberg, Excel's not going to like that because that's coming out text, right? Because I hate putting in hard-coded numbers. Because when I update my model and the years change, if I have a hard-coded number, it will screw me up. But since this is just a very simple example, we're only going to probably throw away. I'm just going to kind of do it hard-coded, right? So not a best practice. You never want to do what I did, right? So actually, let's not do that. So what I'm going to do is I'm going to create, so I'm going to call this the ratios. So I'm going to create another sheet because it'll just drive me crazy. I'm going to call it assumptions. And I'm going to put my miscellaneous assumptions right here on this tab. Sorry. So I'm going to call this assumptions. All right. So I'll make this bigger so you can see it. And one of the assumptions I'll make is first forecast year, 2015. Then what I'll do is I will refer to that there. Make myself feel a little bit better. So that way, and we'll keep it simple, we're just going to forecast. Usually people do 5 years, So we're going to just do 5 years. That's not the right answer, but we'll just do 5 years, and then we'll call it continuing value. So therefore, what I actually need to do is I need to forecast 6 years, because I want to forecast the 5 defined years, and then I want to forecast +1, which is the first year of the continuing value period. So year 6 in the perpetuity will be the continuing value period. The first 5 years are year-by-year forecast to McDonald's. Does that make sense? So here's the way I'm going to keep it simple. I'm just going to forecast revenue by saying equals the previous year. All right? And then what I'm going to do is I'm going to make this a colored cell. I'm going to call it yellow. You can pick whatever color you want. And the reason I'm going to do that is I'm going to highlight that this is something that I could change versus the previous ratios I don't want to change because those are actually calculated historical ratios. So I'm just picking the color yellow, and one, it's easier to see for me, but it also tells me that here's something I could change. You can pick whatever color you want, but I would strongly recommend differentiating the past from the future and what you can change versus what you can't change, because otherwise you'll break your model if you change the wrong thing. So in this case, I'm going to forecast growth. I'm going to forecast EBITDA margin. I'm going to forecast, I'm going to leave depreciation alone just to keep it very simple, because depreciation rates, you'll see, are relatively steady, although they have been growing a little bit. So maybe I would want to forecast it year by year, but practically you're not going to do that. So I'll leave depreciation around 6%. And then what I'm going to do is I'm going to solve for the EBIT by saying EBITDA minus DA. So I'm not going to forecast the EBITDA and forecast the EBIT. I'm just going to forecast the EBITDA, and that will create the EBIT forecast. Does that make sense, what I just did? And then, go ahead. So I'm just saying, since I'm choosing to forecast EBITDA, and EBIT is somewhat based on EBITDA, instead of forecasting the two numbers separately, independently, and having to figure out how they sync together, I'm just going to say I'll forecast EBITDA, subtract the DA, and I'll just say that would then be the EBIT. Does that make sense? I'm going to forecast one representative tax rate for the future of McDonald's, right? And that is going to get me a forecasted NOPAT. So again, I take the EBIT, multiply by 1 minus the tax rate, and that would be the NOPAT that would come out of this. And actually, I don't want to forecast that because it's going to be based on my EBITDA forecast. So what I'm also showing you, and that's why there's 3 cells in yellow, these become the most important factors in your valuation. And this is to some degree what the pros focus on. They focus on the revenue, they focus on the EBITDA, the profits of the actual business, and they focus on your tax rate. So if you think about it, what happened to Twitter, what happened to LinkedIn? They missed the margin forecast, therefore their EBITDA was lower. They missed the revenue forecast, therefore their revenues were lower. You compress the two, you have less cash flows, you have less value. And these are the numbers the pros are focusing on. The other numbers can be created, but these are the most important drivers for the business. Yes? Mm-hmm.
They've been pretty stable, so I see the logic why you're picking up the last year, but in regards to the sales, they've been pretty well.
Well, here's what I'm going to do. And so I don't disagree with anything you said. So here's what I'm going to do, which is I'm going to take these numbers, and I'm going to copy, and I'm going to paste it forward to 2020. And then what I'm also going to do is I'm not going to change the tax rate year by year, so I'm going to un-yellow these future years. Now, I'm putting these ratios in as what I'm going to call placeholders as we build out a simple model. Later, we're going to change the ratios to what we think are more realistic, and that will then change the valuation. But as we build it, to keep it simple, I'm just going to equal the previous year. Just make our lives a little bit easier. Okay? So, continuing on. So now what I'm going to do is I'm going to create a DCF valuation. Actually, take it back. I'm going to create a forecast tab. All right. Now, the reason I'm going to create a forecast tab is because you will probably import data into this model, and I'm going to make it reusable. So you can literally plug and play any company's data into this model, overwrite this tab, and then it'll feed through the rest of the model. Right. So basically what I'm going to do is I'm just going to recreate the historical income statement data here, right? But the difference is, instead of creating all 5 years, I'm only going to create the last historical year, right? So what I'm going to do is I'm going to take equals from our assumptions, the first forecast year minus 1, that'll be my first historical year, and then I'm going to take the data here on the ratios, here on the, yeah, I'll take it in the ratios. Copy and paste equals that all the way down. But instead of growth, what I actually want is revenue. Instead of EBITDA margin, I actually want EBITDA. Instead of depreciation percentage, I actually want the depreciation. Instead of the EBIT percent, I want the actual EBIT. I want the actual taxes. And then I actually want the actual NOPAT in dollars. So on this page, I'm going to switch the percentages back to the dollars, right? And instead of using the historical data, which is here, I could make it more complicated, but I'm just going to kind of keep it simple. So I'm going to take the 2014 revenue. I'm going to take the 2014 EBITDA. I'm going to take the 2014 depreciation. I'm going to take the 2014 EBIT. I'm going to take the 2014, well, I don't do the taxes. So I'm going to take the EBIT times from my ratios, the 2014 tax rate. And then my NOPAT is going to be the EBIT minus the taxes. And I'll put these in 1 decimal place format. I'm not going to use dollars because you could apply this to any company. It doesn't have to be a U.S. company. Right? So everybody see I just did that? Yes? I did move a little fast. I'm interested in watching the time for tonight. But in any event, all I did was I just off the data, I just took all of the data off of here with the one exception of I didn't pull the taxes from Bloomberg. So I used the effective tax rate to basically multiply by the EBIT to get the taxes that I would pay on the EBIT. And then I calculated the NOPAT as the EBIT minus the tax is NOPAT, net operating profit after tax, EBIT after tax. Right? That's my historical data. But here's what matters. It's not, value is not NOPAT, it's not profit. What's value based on? We talked about it last week. Value is based on what? Free cash flow. So what I need is I need my free cash flow. So how do I translate NOPAT into free cash flow? So free cash flow is what? Equals NOPAT, add back depreciation. So plus depreciation equals NOPAT, equals 2014 depreciation gets me something called gross cash flow equals NOPAT plus depreciation. So McDonald's actually generated in 2014 about $6.8 billion worth of cash profit from the income statement. Now this is again just an annoyance of accounting because what we have to do is we have to basically take a non-cash item, all right, and we have to subtract it from our cost of doing business as an expense so that we can actually pay less in taxes. But then, because it's a non-cash item, we have to add it back. That's the difference of the cash flow, and that's why we kind of have to go through this kind of crazy method to basically take out the non-cash item to reduce our taxes, taxable income, pay the taxes on the reduced taxable income, but then add back the non-cash item. Okay, a lot of people get tripped up by that, but that's what the idea of gross cash flow is. The proxy for this is EBITDA. Notice that the EBITDA is actually not the exact same, which is why you actually want to do the math. But a lot of people will just say EBITDA and gross cash flow are the same thing. But in McDonald's case, I would not really be doing a justice to say that because their tax rate's pretty high. All right, in any event. So how do I get to free cash flow from gross cash flow? What do I subtract? gross investment, the investments they made. What are my subtractions? I'd want to subtract CapEx equals 2014. Their capital expenditures were $2.5 billion. Okay, and I'd want to subtract change in working capital. So what is change in working capital? It would be the, now here's where I'm going to differ from what the accountants do and what the book tells you. And again, I just want you to be able to do it right. So what I'm going to do is I'm going to take the current assets, right? That's this. I think the easiest way to do this. I'll do this on the assumptions page. I think the easiest way to do this. All right, I'll just, for now, equals, here's what I'm trying to do. I want to take out the what's called the excess cash from working capital and leave in a little bit of operating cash. All right, so I'll just do it as a formula and see if you can follow along with the logic. So what I'm going to do is I'm going to take current assets minus the cash, and then I'm going to subtract the current liabilities. Okay, so I'm basically taking the difference in the working capital, excluding the cash, right? So it's all the current assets except for the cash, minus the current liabilities. Yes?
Is this just the net working capital that you calculate, or you need to
Correct.
calculate the change?
You want the change in the net working capital. Now, here's the other thing, which is the reason I left short-term borrowings in there. And McDonald's didn't have any in 2014. But technically, when we pay off the debt, short-term debt's part of current liabilities, right? So what I actually want to do is I want to come back here, and then I want to take the current liabilities, subtract the current liabilities minus the 2014 short-term borrowings. That's why I put them on there. Okay. Now it's 0 for McDonald's, so it wouldn't really matter. But what I'm really saying is debt, short-term debt is debt that has to be paid out. It's not really a current liability that's the cost of doing business. And what I'm really trying to do is I'm trying to prevent companies from playing games. And what I mean by that is they have no long-term debt, they can have a bunch of short-term debt, and they just roll it over. Well, that's long-term debt, right? Because a lot of companies will roll over their short-term debt. Well, that's funding the business long-term. That's not just funding working capital for 90 days and goes away. So I'm just going to say all debt's long-term, right? I'm not going to treat any debt as short-term. So I'm just going to move it all into the capital category, right? Again, I'm giving you some nuances, but now here's the other nuance. That gets me working capital without any cash being in the business. Now there should be some level of cash in the business, right? So here's the final assumption, is I'm going to put a percentage of operating cash. And I'm going to use 2%. So what I'm going to say is every company needs to have at least 7 days of cash, 1/50th of the year, that they can't pay out, right? Because that's another problem I have with the academic definition, is they have this concept which they call net debt, where they say debt minus the cash, right? Because you can pay the debt off with all the cash. That can never happen in the real world. There is no circumstance ever where all the cash will just go to the debt holders. Some of it's going to go to the IRS. Some of it's going to go to the lawyers. Some of it's going to go to the employees. So you can never pay out all the cash. And so the amount of cash that you can't actually pay out from the business because you have to run your business day to day, or it's going to come out in bankruptcy before the debt holders get, is called operating cash. So what we want to do is we want to break into operating cash and what I'm going to call excess cash. So I'm going to call it 2% So it's percent of sales for operating cash is 2%. So what I'm going to also do to working capital is I'm going to look at the change in the operating cash. Actually, it's not going to make much of a difference to the company I'm going to give you. That's what you should do. I'm not going to do it because it's starting to get too complex. Sorry, I get to what I actually do. So long story short, change in working capital. Now these are coming in as negative numbers. So if you think about what's happening in the working capital is increasing. Current assets minus current liabilities. Sorry, change. This is, let's call that 2 billion, 2 billion. Actually, let's make sure I got my signs right. So equals current assets minus current liabilities. Make sure I go the right way. Is actually decreasing. So working capital is going down. So think about it from a cash flow perspective. Does that help the firm or hurt the firm? If working capital goes down from a cash flow perspective. I have less inventory in my business. Yes?
When you calculate the change in working capital, should you compare what you calculated for 2014 to 2013?
Yeah, that's what I did. Is that what I not did? Current assets minus current liabilities. Oh, sorry. Thank you. You're right. I wanted to do the change. And I did the absolute amount of working capital. Did I do the change? 12 minus 214. Minus, yes. Sorry, because I took out the cash. That's why it's negative. So you're right. I do want the change. Thank you for pointing that out. So I want the change between 2013 and 2014. Where are we going to make this easier? Let's do it this way. Insert. Equals that minus 1. I'll put 2013 on here. And then what I'm going to do is I'm going to put this is the working capital for each year. So copy, paste 1 year back. So my change in working capital is this year minus that year. Okay. All right. So my working capital improved by 278 million. Thank you for pointing it out. Yes. I'm sorry? Yes. I do. Adding 2% is not going to make that much of a difference. So I do want you, because what I want you to do is if I ask you to value Apple, who now has $198 billion worth of cash, it's going to screw up the working capital because they're going to have all this cash in their books. So yes, I do want you to take it out. Ideally, I want you to put 2% of revenue in there, but I'm just getting complex. So again, back to this. Current assets minus cash, minus the current liabilities. So in this case, here's the thing. I benefit 278 million. I spend 2.5 billion. So my gross investment. Now here's the thing. I know it doesn't really work out this way, but I'm going to show you the signs. Since I have a negative CapEx, I'm going to add the negative CapEx, and I'm going to subtract the, I'm trying to think of the easiest way to do it. See, I want to flip the signs. So I'm going to make this a negative. So you want to think CapEx is a positive. And then I'm going to take this here so that my gross investment is the sum of these two. So that's how much gross investment, and that gets me my free cash flow, which is the gross cash flow minus the gross investment. Okay, so I'm just trying to flip signs to try and keep it consistent. So if free cash flow is gross cash flow minus gross investment, I'm investing $2.5 billion in CapEx. I'm freeing up 278 million on working capital, right? Inventory, receivables primarily, right? I spend net 2.3 billion of the 6.7 billion. That's my free cash flow. I know that was more complex than it probably needed to be. Questions about that? All right. So here's the real point. I'm now going to forecast. So equals previous year plus 1. So what is my revenue for 2015? Well, my revenue for 2015 equals previous year revenue times 1 plus ratios, the 2015 growth forecast. This to one decimal place, right? What is my EBITDA? Equals that 2015 revenue forecast times my 2015 EBITDA margin. What is my depreciation? Equals my 2015 revenue growth forecast times my depreciation as a percentage of sales. My EBIT is my EBITDA minus my DA, right? My taxes equals my revenue times the tax rate. Sorry, equals my EBIT times my tax rate. And my NOPAT equals my EBIT minus the taxes that I pay. Everybody with me? I'm sorry? Okay. As I said, the good news, I've recorded this on video, and I'll give you the file. Okay? I'll make that easy. So, but I want you to understand what I'm doing. Does everybody kind of see generally what I'm doing? Okay. Yes?
Why wouldn't you like average the production and growth rate?
We're gonna come back to changing in just a minute. But what I want to do is I want to forecast 1, 2, 3, 4, 5, 6 years. And notice I now have 6 years worth of cash flows forecasted, profits forecasted, because I'm just using these ratios, which we will change in a minute, to create these forecasted ratios. Yes? So for 2015, I just took the EBITDA, I took the 2015 forecasted revenue, and I multiplied it by the 2015 EBITDA margin off the ratios. So we said 35%, so 35% of that number became the actual dollar amount. Does that make sense? Okay. So, long story short, I now have to create my forecast for gross cash flow, which is easy because I have a NOPAT, I have a depreciation, equals NOPAT, equals depreciation, equals NOPAT plus depreciation. I now have a forecast for gross cash flow for McDonald's. Right? Now, here's what I'm going to do for simplicity, is I'm going to go back to my ratios, and what I'm going to do is I'm going to create a concept known as the reinvestment rate for a business. Remember that from last week? What is the reinvestment rate in 2014? What was reinvestment, just conceptually? What did we say reinvestment rate was? The percentage of the profits that were reinvested into the balance sheet, in the capital, therefore the CapEx and the working capital. Does that make sense? So what the reinvestment rate really represents for McDonald's is in 2014, that was their gross investment. In 2014, that was their cash profit, actual cash flow profit, gross cash flow from operations. That was their reinvestment rate, about 34%. Okay? So here's the idea. Equals that. Now, I'll let you change it year by year, and then I'm just going to copy that forward. Now, you might say, why did I create a reinvestment rate that I'm forecasting? What would the answer to that be? Because if I come here, I got to forecast a gross investment. So what I'm going to do for gross investment in the future is I'm going to take the gross cash flow and I'm going to multiply it by the 2015 reinvestment rate. So rather than forecasting CapEx and working capital changes, I'm going to just simplify it to say I'm going to forecast a reinvestment rate. Right? So what percentage of those gross cash flows are being reinvested? In 2014, it was that's why I said that's why I wasn't going to worry about the operating cash as I thought it through to keep it simple. Now, in the real world, you would probably forecast working capital year by year. In the real world, you would forecast CapEx year by year. But practically, what you're doing is you're forecasting a reinvestment rate year by year. So I'm going to simplify it and say you forecast a reinvestment rate to come up with that gross cash flow. So if I copy this forward, those are the free cash flows for McDonald's for those 6 years. Which are created based on these ratios. So here's how you do the what ifs. If I think McDonald's is going to grow at 4%, then that will come in here and it would have changed everything, including the forecast for the free cash flow. Because now revenue is growing by 4% automatically. This is the dynamic nature of this. With me? Not with me? I lose everybody? Okay, at least one person's with me. All right, so long story short, I now have a forecast for free cash flow for McDonald's through 2020, or at least an ability to do that using these ratios. Okay, so what I'm finally going to do is I'm going to do the valuation. Okay, and I'm going to use what's in the book or in this PowerPoint slide of how McKinsey did Home Depot. So here's the way they kind of did it. They said, okay, what is the free cash flow? And I'll do this on one page so it prints out nicely. Starting with the future for 2015. So equals my first forecast year equals that plus 1. I'm going to just do this as relative references for 5 years. My 2015 free cash flow is this number, 2015, D, 2016, E, 2017, F, 2018, G, 2019, H. Okay, so I'm just taking and transposing this column year by year into these 5 free cash flows. Everybody with me? Yes. Sort of with me. Yeah, go ahead. Depends on how you had those percentages in the future. If you typed in an absolute number, I'm actually using an equal previous year, so there could be some rounding issues. Well, it's actually 34, but not exactly 34. So if you typed in 34, it won't be 34. It's like 30 something point something something something. So it's really close. You're good enough if you did 34. If you're within a couple million of this, you're going to be fine. So back to this. What's the next step? You tell me. I have 5 free cash flows. How do I value them today? I got to discount them, so I need to present value them. So I'll need an assumption called the WACC. Well, the nice thing about McDonald's, these yellow, is we just downloaded their current WACC. And their current WACC is 6.1% according to Bloomberg. So we're going to use that. So 6.1%. So what does that mean? I'm going to call these discount factors. How do I do a discount factor? Equals 1 divided by 1 plus R, which is the 6.1%, Now when I copy it down, I want it to be an absolute reference, so $B, $4. I'll make this 4 decimal places just so it's easier to see. Copy, paste. Now here's the thing, in the second year, I want to square it. Third year, cube it. Fourth year to the 4th power. Fifth year to the 5th power. Time value of money. So my discounted free cash flow equals the free cash flow times the discount factor gives me a present value. So the operating value of McDonald's in the first 5 years is 17 billion and change. Okay, long way to get to that. A lot of work to get to that. This is what we're really trying to get to. We're trying to get to the free cash flows. So that's really why we did all the exercise that we did. So what I then have to do, and again, I'm going to simplify this, but I have to add in my non-operating values. What are my non-operating values? Cash. Now technically I'd want to use excess cash, but I'm simplifying it, so I'm going to add in the cash. And then the other thing I'm going to add in is the long-term investments that they have that are non-operating they made in other businesses. Yes? I'm sorry? Thank you. I skipped that step. It's late at night. But let me do this first. Equals 2014, it's already a present value, so let me look at all the cash on their balance sheet. 2 billion. Let me look at their long-term investments. Now for them it's 0, but for somebody else it may not be 0. And then that would get me something called enterprise value, which is the operating value plus that. Now, as he pointed out, thank you for doing this, I also need something called a continuing value for McDonald's, because we assume McDonald's is going to last beyond 2019. Not going to go away. So here's what I need. I need, and I'll put it here, I need a year 6 no plat. I need a year 6 ROIC, and I need a G. Long-term growth, very, very long-term growth rate for McDonald's. Okay, so here's the thing. If I look at McDonald's for the continuing value formula, if I go back to our lecture notes, what I really want to do is use the same formula we used last week, the key value driver formula, the growing perpetuity formula. That's why I put those 4 numbers on there. Now, as a starting point, we're going to assume that the G is 3%. We can change that. Here's why. We're going to assume that over time, McDonald's will grow about the same rate as the U.S. and European economies, which is most of their business. And generally in the U.S. and Europe, those economies grow about 3% over the long run. So we're going to assume a company's cash flows will grow about with the economies they're in. Now, a little trickier because they're not growing in the U.S., but they are growing in Europe, growing in Asia. But nonetheless, we can tweak that number. But let's call it 3% for the time being. We can always change that. Year 6 no plat, we already have. That is 2020 no plat, which is I-7. So I already have that. And then I just need a continuing ROIC for McDonald's. What level of ROIC do I actually think that they're going to get? Well, here's the thing. If I look at McDonald's ROICs right now, I'm just going to use what they're doing now. We have an operating ROIC, which I'll calculate from Bloomberg, is somewhere around 19%. So let's assume they make somewhere around 19% if we're holding the reinvestment rate steady and their profit margins aren't changing all that much. So somewhere around 19%. We could always change that later. So 19% ROIC. Make that a yellow cell. Right? So here's the thing. Continuing value equals, so I'm just going to put in this formula with the correct order of operations, equals, and I'll do this right off of the assumptions tab. So year 6 NOPLAT times 1 minus the G divided by the ROIC divided by the WACC minus the G. So what it really says is, what did I do wrong? Equals, try this again. NOPLAT times left paren 1 minus the growth divided by the return divided by the WACC minus the growth. There we go. So that would be their continuing value of what they'll generate after 2020. But the problem is that's a value as of the beginning of 2020, which means I got to present value that. So I use the same discount factor just like you did in the case study. So I take equals that times that, right? And then this gets me one more cell here. Let's get some separation. Operating value for McDonald's, which is the first 5 years plus that perpetuity value, about 107 billion. Then the enterprise value is going to be the sum of those three things, the operating and the non-operating assets. And then what I have to do is less all the debt, less any preferred. I'm not going to worry about pensions for now. Let's keep it simple. So the debt was here, total debt. Preferred here. Now, if a company had minority interest, I'd also just subtract the minority interest. But as I said, I'm trying to keep it somewhat from getting too complicated. And that would basically get me a forecasted equity value, common equity value. Common equity, which is the enterprise value minus the debt and the preferred. And then basically shares. That was the other screenshot I took in Bloomberg. Shares outstanding for McDonald's today, 959.1 million. So price, or I'll call this the forecast price. There we go. That would say it would be worth $98 a share. Yes? Mm-hmm.
When you calculate the should you divide by the discount factor rather than multiplying?
Make sure I do this right.
No, here, but in column D.
No, I want to multiply by the discount factor. So it's cash flow divided by 1 plus R to the n. So cash flow times 1 over 1 plus R to the n equals the discounted free cash flow. So that's why we do a discount factor. It's the undiscounted cash flow times the discounted factor equals the discounted free cash flow, or the discounted cash flow. Okay, so this is what I mean by as is. What's their current share price? So obviously the market, 96.55, really? Wow. I was going to say the market, I was going to say is far from this, but they're actually not that far from this. So if you really think about it, so here's how we can be more nuanced. I'm going to go back to my ratios page, and what I'm just going to do here as I go through the ratios, move this over so I can play around with these ratios, but I'm going to put my forecast price right here so I don't have to keep jumping back and forth. So I want to get very close to the current price. So that means I have to adjust those ratios. So here was the final step. I downloaded the earnings estimates. So I kind of know what McDonald's is expected to have for sales next year and the year after based on the analyst estimates. You see that? So here's my last thing I'm going to do. I'm going to come here to the assumptions, and for 2015 and 2016, I'm going to get the sales and EBITDA from the EEO, the earnings estimates that are today at the Wall Street's using. So sales for McDonald's next year are currently expected to be 25,244. 2016 sales 25,115. I'm just using the consensus to see what the market expects for 2 years. EBITDA in 2015 is expected to be 8770, and in 2016 9181. Okay, so here's why I'm doing this. So I want, in my ratios, I want those to match. So what I'm going to do for these 2 years is, instead of forecasting them, I'm going to solve for the consensus. So the 2015 revenue growth rate that the market's using today equals the consensus today minus last year's sales divided by last year's sales. Actually, I'll do this off of the minus last year's sales divided by last year's sales. So long story short, McDonald's is actually expected to fall another 8% next year. It's getting ugly for them. -2%, then -8%. The year after that, the market is expecting McDonald's to shrink another 0.5%. Okay, EBITDA margins equals, for 2015, is expected to be 34.7. For 2016, it's taking the EBITDA forecast divided by the sales forecast, is expected to be 36. Well, that gets me to $107 a share, assuming the tax rate and reinvestment stays the same. So when I look at the consensus for the next 2 years, what would you say is probably going to happen to McDonald's in the future? Well, we got to get down to 90, was it 98? 96? So how do we get to 96? 4 choices. Change the reinvestment rate, change the tax rate, change the EBITDA margin, change the growth. Do you think McDonald's is going to keep shrinking? All right, I got some disagreement here. That's a good thing, because the analysts disagree on this too. So let's say they don't keep shrinking. And let's say they flatten off at 1% a year. Well, that's going to make the share price go up. So if I had to guess, what do you think the market's probably doing? -1%. Now here's another thing. If they're not growing, then in the continuing value, let's go back here, do you think I should use 3% a year into perpetuity if they're not growing the next few years? What if I use 2%? Okay, and then here's the thing. What if I start growing at about 1% a year, or 1.5% a year, or 2% a year? Got lucky. So at similar margins, and again, this is where you have to do some art. This is the art of valuation, because you got to kind of figure out, is it margin or not? But if I look at margins, 36 has been pretty consistent in the range of what they've been doing. So I really think what the market thinks of McDonald's is that the bleeding is going to stop. They'll go to a very slow growth mode, They'll continue a slow growth mode in the future. And at that margin and the current level of reinvestment, that is their share price today. Not as mystical, hopefully, as you might think. Questions about what we just did? Because you're going to have to replicate this. What questions do you have? This is all being recorded, by the way. Yes?
So when you started to plug and play with the various options, are you making educated guesses or you're just kind of...
I do this for a living, so they're somewhat educated, but here's the thing. They're also informed guesses that you're going to make because, first of all, the cost of capital, the discount rate, is actually what the market is using. That's where Bloomberg is giving it, so I didn't have to guess that. The next couple years of growth and margins, I didn't really guess that. I actually used what the market is actually using, or close to what they're using, because I'm using consensus estimates, right, for at least the next 2 years. And by the way, there are 3 and 4 I could have put in there as well, but the first 2 years are usually the most important. So I put those in. And so at that point, the other thing is my educated guess and why I chose McDonald's is that McDonald's is a very mature company that's probably not going to have explosive growth and it's probably not going to go away. So they're almost like a bond. So I didn't actually think that the revenue was going to change all that much, and I thought that their margins were probably going to be consistent. So I kind of knew even before I did this valuation that if I had consistent ratios going forward, I would probably be at least in the ballpark of their share price. I didn't think I'd be within $2 starting here, but that's the point, that they're almost like a bond because they're going to have fairly flat growth, fairly flat margins, and that's the value of fairly flat growth and margins at this discount rate. Yes?
So generally speaking, it's easier to come up with accurate share prices for large institutional...
Well, what I would say is, I would say it's easier to come up with as-is share prices for mature companies. When you're a growth company, like I have no idea what Twitter's revenue is going to do over the next 5 years. That's where I start to run into trouble. Because when my growth rates are like 30, 25, 24, 23, that's big growth. And then the range starts to drop to 15 from 30. That's how I whack out 25% of their value in one day because there's so much uncertainty for that company that the models the analysts have to run through and all the compounding effects make it harder to value. So that's why you see such big swings with some of these early stage companies. So what I would say is mature companies are easier to value. Growth companies are hard. The very hardest, startups with no track record and no value whatsoever. Does that make sense? So for your homework assignment, as a group, half of the homework. The other half we'll do, I'm going to give you a 5-minute turbo break, but the other half is going to be the multiples, right? Because multiples are an alternative form of valuation that have to give you the same answer. So I'm going to explain to you how multiples work. So what you're going to have to do is you're going to have to value another company as is. By the way, there's always 2 valuations that you do, right? First is the as is, which is basically, and this is something a lot of people skip, which is model the current share price, right? And I find value in modeling the current share price because what it gives us is a general understanding, now some degree of range, but general understanding of the growth and margins that the company and the reinvestment rate that the market's probably looking at for the company. So as is, but then what they do is they do what they call final, where they come up with a target share price. So they put in my assumptions as an analyst that differ from these, because maybe I don't think that this is realistic, and that creates a target share price. The difference between the two, buy, sell, hold. That's exactly how the buy, sell, holds are created. So I create a target, I compare it to the current, that gets me the buy, sell, hold. The additional step I'm showing you is I think it's an extra value in modeling the current. So half of your homework assignment, which is probably most of it, is going to be give you a company. You're going to have to basically take the data. You're going to have to put it in here. I'll give you this as a starting point, so you don't have to start from scratch. You have the video to help you. You'll do this as a team. Is you're going to put in assumptions, though. You have to change the assumptions to do an as-is share price. And then I'll let you have some fun. Then I'll let you be stock pickers and tell me whether you think it's a buy, sell, hold. So then you can make some changes in assumptions, come up with what you think a final share price is. So you're going to submit 2 files. So file number 1 will be the as-is file. And so just get really close, like call it within $1 is probably close enough. But get really close to the current share price. And then change the assumptions to what you think is more realistic, whatever point of view you have, and then give me a target share price. And then the rule is if you're within 10% of the current share price, we call it a trading range. That's a hold. If you're more than 10% from the current share price, that's a potential buy, because on a discounted basis, you think that there's value buying the company. And 10% less than the current share price, get out. That's a sell. Right? And that's pretty much the rules that the market uses. Some banks say 15%, but generally 10% is what most people say. They call it a trading range. Questions? Yes?
Kind of abstract. You use the same method when you price options as well?
No. Completely different method. And if we have time next week, we can talk about option pricing. But option pricing is a completely different model. Right? Other questions? All right, so 5-minute turbo break. Real 5-minute turbo break. I know it's been a long time, but I do want to get to multiples before we leave. Real 5-minute turbo break.